It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the Jill on Money Show, the final show of 2023. And boy, do we have a great show for you. I am so excited to bring on this guest. Oh my gosh. So let me just first say thank you all for listening all year long. This program is all about you. It's about your financial concerns and your questions. And if you've got a financial question, you can always give us a holler. Go to jillonmoney.com and click the Contact Us button. Let me also tell you that we are launching another show. I can't believe it. It is a YouTube show. So video, it's called Jill on Money, powered by The Compound. And we have links to it on our website at jillonmoney.com. This new show came about because I was a guest on The Compound and Friends, co-hosted by Josh Brown and our guest today, Michael Batnick. Now, that show is a real investing show, but these guys work for a registered investment advisory firm. And so I want to make sure that you guys get a sense of where they're coming from, and then maybe you can check out the new show. So here is the first part of my interview with Michael Batnick.
I did not take my education seriously whatsoever, and I paid the price for that. And it occurred to me at 20-something years old, oh, this is why those dorks pay attention in class and do their homework and get good grades, so that you're not cold calling strangers. And so that's what I did. Coming out of college, I was a year and a half late. It was during the heart of the great financial crisis. Really good time to be coming into a career in finance with a horrible resume. I had Cabana Boy on my resume. That's how unserious I took.
But can I just say one thing? Where were you at Cabana Boy? At ABC?
Sunny Atlantic.
Okay. So I think in a weird way, sometimes when I see those little details in a resume that has other things, I think there's somebody who knows how to deal with people.
You know what? Thank you. You know what else my resume had?
What else?
Valet parker, waiter. So I was a worker.
Which of those jobs did you like the most?
I was a worker. I loved being a Cabana Boy, and I enjoyed being a waiter. I enjoyed working.
Okay. So you said, but Cabana Boy kind of limited unless you're traveling between New York and Florida.
It was a summer job.
All right.
So,
what else?
So when I graduated from Queens College, after being politely dismissed from Indiana twice,
Not once, but twice.
I got a job at an insurance company right here on Fifth Avenue. My first day walking around seeing people in suits, like, see, I made it. It's okay. I was right. I didn't need to pay attention. Like, whatever. No big deal. So, yeah, that illusion or delusion wore off very quickly. Very, very quickly. So we were in a bullpen, making phone calls, just getting lists, and the product was life insurance.
All kinds.
All kinds.
Whole life, term, disability.
Everyone.
Okay.
And if you could sell them a financial plan, all the better. So you sell them a plan, you sell them life insurance, you sell them disability insurance. If they don't have money for the life insurance, you find the money. I was there for a year and a half, and I was the last one in my class. And not because I was successful. It was the exact opposite. I was so unsuccessful, I couldn't leave. I had
nowhere to go.
I had nowhere to go. And what did I want to do? I don't know. I wanted to be in the market.
That was what you said. I want to be in the market. So you did have some curiosity around investing. That was something you liked.
That stems from, it's funny, I spent so much of my professional career talking about why the dangers of picking individual stocks. Now, I'm a hypocrite because I still pick stocks. I still love to do it. But it's not where all my money is. It's, as you and Josh were discussing, it's my fun money. Now, it's a little bit more than fun money, but it's fun. I don't.
You're young.
Exactly. I have no delusion that I will beat the market, but I love it.
Okay.
But my life was actually changed from an individual stock.
Which one?
Celgene.
Oh, interesting. Who owned it?
My mother.
Okay.
So my parents got divorced when I was young. And my mother she went back to work. She was a secretary. I don't think she ever made more than $40,000 a year.
Okay.
And her brother, who also loved the market, got that from his grandfather, bought shares in a small biotech company in 1996. And my mother turned, I don't know what it is, $15,000 literally into almost $1 million.
Really?
$1 million.
Wow.
Yeah. She never sold, got cut in half many times. And so Celgene was a buzzword around the family.
Yeah.
Growing up. So I was a little bit curious, but you would think it's interesting, and I've thought about this. Why didn't that trigger a rush, like a real curiosity like, oh my God, you can get rich picking stocks.
Right.
Like,
This can go from 15 to $1 million. And how do I do that many more times?
Right.
Right.
That would be a logical conclusion or lines to draw for a young person. It didn't click with me.
Okay.
For whatever reason. Now, I made my mom buy me Celgene options for my 18th birthday or 21st birthday. I can't remember how old you have to be.
That's kind of funny.
Which I doubled my money and then rolled it again and lost it all.
Great.
So there was always some sort of mild curiosity around the market. And then when I was at the insurance company, my father introduced me, my father was a periodontist. He introduced me to one of his patients who was a broker at Wells Fargo. And this gentleman, I guess, took a liking to me and every day would send me articles. Now, this is 2008, 2009.
Wow.
Dave Rosenberg, Breakfast with Dave, Ed Yardeni, and I can't remember who the third one was, but I found like I felt my calling. Like, oh my God, this has been here the whole time. How am I only just discovering this? So I would go into my office, and I would, I guess, sort of pretend to be on phone calls. I was floating, no salary, and I was actually, to add insult to injury, I was paying rent for the privilege of working there.
Like rent is like you were a hairstylist.
I was
renting
paying
a chair.
I was paying $300 or $400 a month.
Oh my God.
Without a salary.
I didn't know they did that.
Where did the money come from? I saved. I was rich as a young person. I think I saved like $30,000 or $40,000 because I was working full time for all those years. And so that all that money went to zero as I supported myself. And those were dark days. I had my eye was twitching for like 8 months. My mother was dying. My bank account was getting drained. I had no hope for a career. Like, it was dark. And so I eventually left the insurance company because, I mean, it was getting comical. You know what I mean? Like,
yes, of course.
I hadn't, to say that I didn't believe in the product or the industry. Now, life insurance is important.
Yeah,
People
we
need
talk
life
about it all the
insurance.
time. They don't need all the crap that's sold to them, but some form of term life insurance is very important.
Whole life is not the answer for everything.
Or even anything. Maybe 5%.
But my wife's father passed away when she was very young. And it blew up their family's financial life.
Of course.
So it's you need life insurance, but the way that it was being sold was really gross.
I know.
So luckily, I didn't sell any policies. I think now my father bought one. I bought one for my girlfriend at the time to meet the quota, which I didn't meet. And so I was there for 18 months, not selling anything, but I was paying rent, and I guess they left me alone. So it just became weird that I was there for so long. Like, people were like, who is this guy? At least that's what I'm sure nobody was saying that. But so I left with nowhere to go except for the library.
Okay. Oh, I love a library.
That's where I went.
And isn't it funny? Your office right across the street from a library.
Yeah, not this library. I went to the Merrick
understand.
Library.
All right. And you were studying up?
And I was studying. I was aggressively making up for lost time. And so it was time to get serious. And so I would take my wife, or my girlfriend at the time, now my wife, I would take her to the train station, and then I would spend 9 hours in the library.
Oh, my God. And what were you reading?
I started with The Intelligent Investor.
Of course you did.
As one does.
Right.
The way that I describe knowledge of any kind, certainly in finance, is like, and history, I guess, when you put your thumb on the iPad and the fingerprints show up for the first time, and then every time you press them down, they fill in more and more and more, and the gaps eventually all get filled. I did that.
We'll get back to our interview with Michael Batnick in just a minute. This is the Jill on Money Show. If you've got a financial question, go to jillonmoney.com and click the Contact Us button. It's just that easy. Jill on Money will be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are continuing our interview with Michael Batnick. He is the co-host with Josh Brown of the Compound and Friends. Here is part 2.
I always had inner confidence, but not external confidence. I wasn't going to really impress anybody in a first meeting. So I just thought, I just need somebody to give me a chance.
But meanwhile, can I just do like a personal
Please,
finance
yeah.
question? So your then girlfriend is sort of helping to support you at that time?
So when my mother passed, she left me money.
The Celgene stock.
Celgene
You
money.
got to step up in cost
So
basis.
I was 25 years old with a couple of $100,000, and I thought, I mean, what do you think I did? I thought I was going to be Paul Tudor Jones. There was obviously a massive emotional attachment to the money, right? So I didn't take any big losses. Like, obviously, I didn't blow that up.
Right.
Because it was my mom's money. It wasn't mine, it was hers. So I would buy a stock and stare at the screen and hope that my magical staring would make the price go up. And believe it or not, it didn't work.
I mean, that is shocking to hear.
It didn't work. So yeah, no, I was flailing. I was applying for jobs all over the place. I almost considered moving to San Antonio for an external wholesaler role. You don't need to move to San Antonio for that.
No.
They were like, "What are you doing, pathetic weirdo?" So I was very close to just throwing in the towel. At this point, it was probably like 2011. So it's a year and a half, like literally unemployed. Not like nothing going on.
I'm worried for you right now.
I was very worried for me. It wasn't great.
Tell me about a girlfriend who loves you so much that is going to stay by your side while you're flailing about. What did she see in you? I know. I love that I made Michael cry so early in the pod.
A little bit. How bad were her options? Oh my goodness.
No, that's not how I framed it.
We were relatively young. So. And to her credit, I'm sure she had this conversation with her friends, but she never threatened like, you have 2 months or I'm leaving. Like, I don't know what she saw, but she stuck by me.
It's a very sweet thing. I mean, it's hard to get through those times, and it's easier when you're in your 20s. But at any time, all right. So let's get back. She loves you. You're flailing. How do we get you to Ritholtz?
The last hope that I had. This was Michael Batnick. The last hope. I had an interview. It was not an interview at JetBlue.
Okay.
My cousin was an early JetBlue employee, and I walked into the CFO's office. I think he gave me about 2 minutes. I was like, "What are you doing here? Wait, you want to be in finance?" Like, it was not a great interview. I mean, I did not do well. Anyway, so I'm going to the Knicks game. It was a playoff game.
And you're a lifelong Knicks fan.
Love the Knicks more than anything.
More than the Giants?
More than the Giants. I mean, it's 1A, 1B. It's 1A, 1B.
Okay.
And so it's Game 3, 2011, and the Heat are in town. I should be very excited.
Yes, you should.
As I was sitting in my seat, I get an email from this person. "Nice to meet you. Sorry, we can't help you." And I was despondent, not because I thought that I was going to get a job there, but I really didn't know what to do. Like, it was throw in the towel time, go get a job, just be a waiter, and I don't know, maybe you'll figure it out. And this was a light bulb moment for me. I really do remember it like it was yesterday. And my friend said, "What's wrong?" I showed him the email, and I was upset. And in the third quarter, Mario Chalmers hit a three to put us down by 21 points. And I said, I'm leaving. And there was probably 2 minutes to go in the third, something like that. And my friend goes, what do you mean? Where are you going? It's the playoffs. And I said, I got to go home. On the way home, I'm on my BlackBerry, and I'm scrolling through Twitter.
I love BlackBerries, by the way. I'm sad that I have an iPhone.
They were good. They were good. And Josh is tweeting about
downtown Josh Brown, the reform broker, tweeting, and you're following him.
So Josh was really my North Star.
Really?
He was the person that if I could have worked for anyone, it would have been him.
Because he made the transition from like almost a similar path as you?
Yeah. So what his story and the truth that he was telling, I lived a similar experience. Different product, not quite as gross, but not great.
Yeah.
Same incentives. And he was telling the truth and he got out. And so Josh is tweeting about how old he feels because Kurt Cobain's daughter, I think it was Kurt Cobain's daughter had just turned 18.
Oh.
And so he's tweeting about it. And as we pull into Merrick train station, my phone died, which is a very important detail. Because if my phone didn't die, I would have
been looking at your
been
phone.
looking at my phone.
And amazing. Put your phone down. What happens?
My phone died, so I put it in your pocket, and I walked past Josh.
Oh, wait a minute. Hold on. Here's your idol. You recognize him.
Yeah.
He walks by you?
Yep.
Do you do a double take like one of these? Or did you say, "Oh my God, I love you," or what happens?
I froze. And I said, I have to turn around and talk to this guy.
Okay.
So I froze, skipped a beat, and said, "Turn around." I tapped him on the shoulder, and we spoke for 20 minutes.
Yeah.
and my girlfriend wife was waiting for me at the train station, and she said, "Who was that?" And I said, "That's my Bethany Frankel."
Oh, very nice. And so what happened after that?
So after that, I had followed up with an email, and I don't think he got back to me. It was in the spring, I think, that he posted, "Barry and I are hiring."
Boom.
Yeah, exactly. So I got in his inbox or his Twitter DM, and I interviewed.
I know that you're a CFA now.
Yeah.
But did you start that process
Yes.
prior?
Yes.
Okay. So can you explain to everybody what is a CFA and what that process entails?
Yeah, so the Chartered Financial Analyst designation was very, very important for me for two reasons. Number one, I didn't know anything. Like, I knew nothing. So I think I took the first exam my mom was still alive, so in 2010. And I passed the first one. The second one was rough because my mother was dying. I was studying in the hospital. The second one was a tough exam. I was not in the industry.
Right.
This is like
And
serious.
you didn't study at undergrad. There's a lot of people
No,
go and take
yeah.
the CFA who are like, I got it. I have an MBA already.
So everybody that takes level 2 is at an investment bank.
Yeah.
Right? Like they have experience. I knew nothing. I took the test and I came home and cried. It was a disaster. So, but by the time I met Josh, I remained obsessed with the market and didn't give up on my dream, which was to somehow get a career in the markets. Like, I remember sitting with somebody, they're like, "Well, do you want to work on the buy side and the sell side?" And I was like, "Dude, any side.
Doesn't matter.
I don't even
right
know.
down the middle.
I don't know which side is what, but any side." And so after I met Josh, it was great. We grew up in the same town.
That's also a bizarre coincidence.
So across the street from each other, I don't know if there was any overlap, but when I got divorced, so before my parents got divorced,
Oh, okay.
before my parents got,
Okay.
no, I'm married once. Before my parents got divorced, I lived here and he lived across the street 2 houses over.
Okay.
So he's 8 years older than me.
Right.
So I don't even know if there was any overlap, and even if there was, we wouldn't remember it.
Right.
Yeah, so we grew up in the same town, so there was a lot of, familiarity.
Yes.
We spoke the same language.
Right.
So the interview went great, and I said to my wife, I remember seeing a stack of resumes on his desk, and I said to her, if I don't get it, it's just because there's people that are more qualified, and boy, were there ever. Now, the advantage that I had was that I had some money in the bank for my mother, and I would have worked for free.
So you start what year?
This was 2012.
Okay. So just to reframe where we are, it's 2012. It's after the financial crisis. The financial markets have come back, even though everybody's like, no, and nothing's ever going to happen good ever again.
Yeah.
And I remember it so well, by the way, because I remember everybody being so negative. And you're chugging along and you get this job, you love the markets, but you're now working for an investment advisory firm, which is not a stock picking firm.
Mm-mm.
So what is the role that you thought you were going to take on, or what were you aspiring to become at the firm?
I don't know there was a job description, and I don't know that I asked. I would have done anything to work for them. And so the job was this. Everything, anything. What can you do?
Right.
The first day, I remember Josh tapping me on the shoulder and saying, "I'm going to CNBC, get me some notes." And I was over the moon. I couldn't believe that this was happening to me.
We'll get back to Michael in just a minute. Check out the new YouTube show. It's on our website, JillOnMoney.com.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we're continuing our interview with Michael Batnick. He is the co-host with Josh Brown of The Compound and Friends, and he writes the Irrelevant Investor blog. What do you do now for the firm? You're the chief investment officer of the firm?
No.
Not really?
No. So
but you are like the resident egghead.
I'm on the investment committee.
All right. So what does that role mean for you? Like in terms of you're setting a tone for advisors who are Ritholtz advisors. Are you creating models for them, or is everyone a free agent? Like, how does it work?
Yeah. So we don't want any client outcome to be dictated by an advisor doing something that we don't believe in. And so our advisors have full autonomy to take the client through the process, create a financial plan, deliver the portfolios that we manage. We pick what goes inside of the portfolio, and it's up for the advisor to say, we think this model works for you.
Got it.
Some munis, some this, some that, whatever the case may be. I'm not talking to the advisors necessarily and them saying, hey, what do you think is the appropriate portfolio for this couple given X, Y, or Z? So I am on the investor committee along with Barry and a few others, and we determine the options for advisors to.
Oh, that's awesome. So let's talk a little bit about investing, and I know you love it, but in terms of the wealth building versus gambling, because it's fun to gamble.
Love it.
It is. It's fun to gamble. So when you look at long-term investing, if someone calls my show and comes on the air with us on this program, what is your view on passive investing, model investing, exchange-traded funds, index funds, like the general approach to long-term wealth? What is the Michael Batnick approach?
Who am I talking to?
You're talking to individual investors who have more than a 10-year time horizon to build some wealth. You know, we're not talking about their fund money account. We're talking about what should they do to build, like the do-it-yourselfer who wants to go to Fidelity or Vanguard or Schwab or E-Trade and do it themselves.
So I don't think this is debatable. Investing's been solved. It's not a mystery. We know what to do. The best way for regular people who are not obsessed with the market, most people aren't, nor should they be, is to create a portfolio that you can stick with for the long term. That's not easy. It sounds very simple to say it. There's a line. Everybody has a line. And unfortunately, you don't know where your line is until you cross it. And you'll learn through the experience. So once you've figured out your risk tolerance, index funds are the best way to go. Now, I'm not an active hater. I think that, bless them, they set prices for the market. I think that there are absolutely some people that do have alpha that can beat the market.
Yep.
But that's neither here nor there. For regular people who have no interest in doing any of that, your time is better spent on everything outside of your investment portfolio.
We talk about that with career. We talk about that with family. We talk that, I mean, you lost a mother at a young point in your life. Like we were just talking before we came on the air, like you go to a funeral and boy, does that reset your brain and say what is important. So if you think it was incredibly important for you to be poring over spreadsheets and analyzing whether you should have the SPDR ETF or the S&P 500 fund at Vanguard, I think you're going to want those hours back in your life. Okay, that's just me. It's shocking for me to admit this, and I've done it many times. I am a complete wimp when it comes to investing. I don't like investing risk. I really don't. I'm not into it. I had it in my life. My dad blew out of his trading account 2 or 3 different times, very much seared into my memory. And even when I was a trader, I was a day trader on the floor of the commodities exchange where, you know, we could do conversions for $1. Like basically we could, like you could make $1,000 a day and not take risk. You could have it go home flat. And that's what the beauty of a trading floor is. You're a bottom feeder, essentially, just picking up quarters that people are leaving on the floor. Okay, but in my real life, I have always been more of a 60-40 investor because I'll take risk in my career, I'll change careers, I'll reset my life, I'll just do something totally different. But generally speaking, 60 a little bit risk, 40 less risk. And for so long—
How'd that work out?
Pretty freaking good. Pretty good. And I sleep at night. You know, so many people have really been freaked out by this 60-40. 60-40's dead. 60-40's dead. 2022 is a terrible year for stocks and bonds. So is 60-40 dead?
Poppycock.
Poppycock.
It's alive and better than ever. For so many years, the 40 part of the 60-40 wasn't really pulling its weight.
No.
And bonds are really a function of arithmetic. The stock market is a biological, amorphous blob of emotions and numbers and different time horizons and all that sort of stuff. You could tell me everything about the future of a company, about the macro, and I couldn't confidently tell you what the stock would do. With bonds, it's just arithmetic. What's the starting coupon? That's probably what you're going to get over the term of the life of the bond. Prior to the pandemic, you were getting 2% on the 10-year Treasury. And right? And so the stock market did the heavy lifting, gave you 14, 15% a year for a decade. Amazing. Those days are probably behind us. I don't think you should count on 15% for the next decade.
No.
If we get it, I won't complain, but you shouldn't count on it. What you can count on is with the 10-year closer to 4%, you can now get, I mean, that changes things dramatically.
Yeah.
So yes, we had to take, and over the years I had been saying to investors, we're going to have to take a step back to take a step forward with bonds. Because the only way that our fixed income is going to pay us a higher rate of return is if the fixed income goes up.
Yeah.
When the fixed income goes up, the prices will go down. Now, 2022, we ripped the Band-Aid right off.
That was a rough year, man. I mean,
it was tough.
I've had some bad years in my career, but last year was a rough year. I was so happy not to be in the investment management business.
It was hard.
It was a tough year.
It was hard. We've been trained, the social contract, the financial contract that we've signed as investors is I'm taking risk in my stocks. I'm comfortable taking risk in stocks. I believe in capitalism up and to the right. The bonds are the safe part. And that was ripped into a million pieces. And it was really difficult because bonds were supposed to save you. And in fact, not only did they not save you, they were the reason why stocks went down. And so it was the double whammy that nobody wanted to swallow, but we got through it.
More with Michael in just a minute. This is the Jill on Money Show, and we will be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. We are here trying to help you take better financial steps forward. And we do that by encouraging you to go to our website, JillOnMoney.com. JillOnMoney.com and clicking the Contact Us button. Now, that website is where all of our content lives, our podcasts, our free weekly newsletter, and we have a link to our brand new show. It's on YouTube. It's called Jill on Money, powered by The Compound. And The Compound is The Compound and Friends, a great podcast hosted by my pals, Josh Brown and Michael Batnick. And Michael is our guest today. So now we are going to tap into Michael's brain and see what he expects from the Federal Reserve in the year ahead. Without getting too in the weeds, we have a Federal Reserve that was late to the game. They waited too long to start with their interest rate increases, then they go really fast, and then here we are. So 2024, how do you think this plays out in terms of where the Fed goes from here?
The Fed threaded the needle, is what Ben said to me on the podcast yesterday. And I said, no, they absolutely did not. They were recklessly driving 100 miles an hour, drunk, slammed on the brake, and managed to avoid an accident. They don't get credit for that, in my opinion.
I agree with you. I agree with you. Starting back in the mid-2000s, frankly. I can go back to Greenspan and say how much I hate him.
And they were drunk on Goldschlager. Like, it was ugly. So what do they do in 2024? When do they cut? Obviously, I don't know. What I do know is that the market will react before they do. Mm-hmm. And you see that happening. The bond market is already cutting, right? Rates are significantly off their highs. But it does matter. The cost of capital absolutely matters, but maybe not as much as we thought.
Say more about that.
Well, monetary policy is a very blunt instrument, right? That's the phrase that people in finance use. It's not surgical. It's not precise. And what it really impacts, not necessarily consumer behavior, the housing market, which was where the wealth effect comes from it. But what they couldn't have predicted, or I don't think they could have predicted, was that you can't fix the demand problem for housing. That is structural. There are 70 million millennials. A lot of those people need to buy a house.
And really want it badly.
And that's not always a financial decision. You have a first child, you have a second child. Okay, square feet, you need more of it. So what the higher interest rates did was it did nothing for demand.
No.
But it killed supply. Because people said, I can't afford to move. I have a 3% mortgage. Where am I going?
Yeah, I'm locked down in my place.
And so it kept prices high. And not to mention, 65% of the nation owns a home. How many of them have a mortgage rate that's below 4%? Most of them.
Yeah. So if we look ahead, how important is it for people to think about what the Fed is doing? Like,
Through what lens?
I'm an individual investor. Like, I watch CBS Mornings. Jill's on the air. I talk about inflation. I say, it's going to come down. Calm down, everybody. But, inflation, also, I would say the Fed, the reason why I think the worst part of the Fed and being late, not just that they were reckless, but when they waited to slam on the brakes. They could have kind of pumped the brakes sooner. And I don't think inflation would have spiked by as much. And I think that consumers would not have freaked out so much. Now, yeah, I get it. War in Ukraine, energy prices beyond their control. But it is possible that the Fed made the inflation pop much more dramatic and indelible in a lot of consumers, which I think is why so many people are like, everything costs more. Everything does cost more. And I can't stop myself from thinking that even if I got a raise, even if my house is up in value, but gosh darn it, it is expensive to go out to dinner.
People feel like they deserve their raise. They don't deserve higher prices. And you adjust, right, as one does. Cool, I got a raise. It's a nice adrenaline rush for maybe 3 paychecks. And then you get used to it.
Yeah.
But oh my God, my Chipotle costs $14 and I see that every day and I can't get over it.
Right.
And so we had 10 years worth of price increases in a 20-month window. And that's why you see all sorts of funky things going on between the sentiment, how people feel versus how the economy actually is. Mm-hmm. It's understandable. People are pissed off. Everything's so much more expensive. I'm pissed off.
Really?
I mean, a little bit, yeah.
Why? What's wrong with your life? Things are good.
Listen, I'm the luckiest. We just went over my story. I am truly the luckiest person that I know. But no, I'm empathetic to why people are pissed off.
I agree with that. And I think that, I learned this lesson early in my career. I think one of the first times I was on CBS was on the early show in 2008. And I was talking with Harry Smith, who was the anchor then. And I said on the air, don't panic, because the markets were getting crushed. And my mother called me up and she goes, you should never say that.
That doesn't work.
She goes, don't say that. I am panicked.
I'm scared too.
And I'm scared.
Yeah.
Tell me that it's okay to be scared. And now tell me why I can stop being as scared as I am. It was like the best note that my mother's ever given me.
You would be very proud of me. Those were the conversations that I was having with our clients in March of 2020. Now, I'm not an advisor. Mm-hmm. I'm not a CFP.
Right.
These are not my relationships. But when things like this happen, they want to talk to the investment person.
Right.
And that was my message. I'm scared too.
I'm scared too. It's
and
like
then
you don't know.
If you could empathize and be a human being and then maybe also provide some data to help with
Right.
it, then I think that's a pretty good recipe for success.
We've got one more segment with Michael. This is the Jill on Money Show, and we'll be right back. You're back. It's Jill on Money. And before we conclude the hour, let's get back to Michael Batnick. So you've now been doing this for a dozen years. What's the most surprising thing that strikes you about the business, investing? What's surprising to you?
Oh, man, I wish I had time to think about this.
You have at least 20 seconds.
This is not an answer, but maybe it's my own. I'm still obsessed with the market. I was talking with Josh about this. Like, I feel like when Josh is done, he could be done, But I don't think I'll ever be done. I think when I'm 70, like, unfortunately, I will still be at the screen.
My dad, when he left the trading floor, he got with a bunch of his buddies from the American Stock Exchange. They created their own mini desk off the floor. They finished doing that, and they were, let's say, in their 60s, and they all retired. And still, my father, just because he was that kind of person, that he would sit there with his yellow legal pad, watching CNBC, watching the runoff, marking his positions by hand with his calculator, looking at his options expiration, trying to figure out what to do next. And I begged him to please, as he got older, to clean this up and keep one fund money account, but keep the real money somewhere else, so that if something happened to him, that it would be easier for us with my mother. And he was okay with that. Like, he didn't care how much. He did want to be in it. That was the thing that was very interesting to me, that he was, it could have been $10,000, $100,000, or $1 million.
Well, it's a game, and we like playing.
And he really, and it's like saying to somebody, I really love bridge.
Yeah.
By the way, traders are great bridge players.
I don't know about bridge. I know Warren Buffett likes bridge. I don't know about bridge. I think I recognize that people are very bad at predicting how they'll be in the future.
Yes.
And I understand that, you grow up and things change. And I don't know, maybe when I'm 70, I will want nothing to do with the market. That's possible. But I love it. I really do. It's the first thing I do in the morning and the last thing I do before I go to bed.
If you want to check out Michael Batnick's stuff, we'll have links in our show notes. This is the Jill on Money Show, and if you've got a financial question, we'd love to have you on the air with us. JillOnMoney.com. Click the Contact Us button. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's the Jill on Money program, and we are here trying to help you make better financial decisions. And if you missed any part of this program, you can always go to our website, JillOnMoney.com, and under the radio tab, you can see the whole program there. It lives on YouTube. And another exciting thing that's happening on YouTube is that we've got a brand new show. It's a video show. Our YouTube show is called Jill on Money, powered by The Compound. And The Compound is my buddies, Josh Brown, known as Downtown Josh Brown, and Michael Batnick, known as the Irrelevant Investor. They are co-hosts of The Compound and Friends. That's a great podcast. And they've helped me launch myself into the YouTube video universe. So I am coming in under their beautiful channel. And if you want to check out the show, all you need to do is go to our website, JillOnMoney.com, and we have a link to it. And you can check it out. We're dropping our shows every Saturday video, and Mark is on as well. So that's kind of cool. So now let's get back to you. We are here trying to help you solve your financial problems, questions, issues. We are going to talk to John, who's on the line from the Southeast. He's trying to help out his mom.
She went through a rather major life transition when my father passed away about 3 years ago. And my father really was responsible for all things, financial in her life. So over the last 3 years, I've been side by side with her, trying to, help her. And I think we've done a great job getting her situated and dealing with all the things that comes after somebody passes with life insurance, et cetera. We got all those funds centralized in one account with a large brokerage firm. And as many people have experienced recently, of course, the balance is dwindling. But as I look at the statements, I do see a fee of about $400 per month.
Hold on. $400 a month or a quarter?
It looks like about $400 a month. It looks like, which is on the balance about 1% is what I'm seeing.
Okay, so she has $400,000 in there.
Yeah, it started at around 600. She's back now at around 500, and she dipped below 500 at one point. and she's drawing every month about 2,000 from it. But what I'm seeing is, of course, the fee there, and the fee makes up about, a quarter of her drawdown. And, having listened to your podcast a fair bit, I was trying to suggest that maybe she could do this on her own, because this large brokerage firm really doesn't do much. That the administrative assistant calls her, every 6 months and asks a couple questions, and that's about it in terms of the interaction, really. She's overwhelmed and concerned, but so I wanted to seek your and Mark's guidance as to whether we could, make a switch, how we could do it. The allocation's really interesting too. There's some bank stocks in there that she's owned for 30 years. So I'm guessing the capital gains, that's about a third of the portfolio, will be substantial. So anyway, she has some pension funds as well as this, but I want to make sure obviously this lasts her, appropriately and can maintain that drawdown. And at 2,000 a month, it should be staying flat, and it's falling. And of course, that's concerning for her and me. So just wanted to reach out and see what you thought.
How old is your mom?
She's 79.
So she's still pretty young, and she's healthy. Life's good for her. She feel okay?
Yeah, she's incredibly healthy. She had a very recent broken patella that we're working through right now, but I expect her to be back on her feet in no time.
So right now, the source of her income is Social Security. And did you say she also receives a pension?
Yeah, she has 2 small pensions. They total $2,900 a month.
And what about Social Security? How much is that?
Social Security is small, $775, and that's because, it was my father's. Obviously, it split when he passed, and then also he spent a lot of his career in another country.
Oh, okay. So she's got this, let's call it $3,700 a month, plus this $2,000 a month from the brokerage account. Is there any other money that she has? Does she have money in the bank? Is there money in a retirement account? What else do you have out there?
Not really. She has 2 paid off pieces of real estate that are, she's using both. But I think ultimately her belief is that she would unload one for the money and 2 for just, simplicity in life as she gets older.
How much are those worth, each of those? One she lives in, right?
Yeah, probably, I would say 700 for one and 600 for the other.
Is one like a vacation home and one is a primary? Is that how it's kind of classified, or is one rental property?
No renting. I would say it's vacation.
She needs this extra $2,000 a month. Why? She's got $3,675 a month, and she really needs this extra money. Why? Because of the upkeep of 2 homes. Does she still spend? Does she belong to a club? Give me a little bit of paint the picture of mom's life.
Yeah, prior to the patella incident, she was a very avid, sports person and belonged to a club and still does, and and then HOA and everything else. I mean, she could probably shave off some of that 2,000, but there's a portion that's needed from that brokerage account for sure.
Mm-hmm. What if you said to her, Mom, how do you feel about selling whatever, the $600,000 place? Would she be like, no way, you're on drugs. You're not doing that, honey? No,
I think she's prepared for that, but I think she's overwhelmed because of, what would have to be moved and how would I do it? And, I've kind of reassured her that we can handle all that. But I'm also sort of, as her son, saying, let's not rush into it. I mean, you're still finding enjoyment in it. You don't need to do that right now.
Do you have siblings, John?
I do. I have 2.
And they're not involved with managing this with her because you're nearby, or just because you're the one who has money and time, you can do it?
Yeah, a little bit of both. Yeah, one is not close, and the other one is just not as aware. Doesn't work financial space much.
I got it. Okay. I mean, first of all, there's a few different things that strike me on this. The anxiety that you're feeling about the account moving up and down, it's a little bit of the, you live and die by the stock's performance, right? It's just unfortunate, but that's where you are. if she's selling some and paying some capital gains along the way, it's not the worst thing in the world, right? She's in the 15% capital gains bracket, and she doesn't have a mortgage on the $700,000 or the $600,000 property. So, she's got like expenses that are real, and then she's got a pretty low tax liability, and all this is fine. Like, it's very normal. The one thing that just pops out to me, like until you told me she had a second home, I almost was going to say to you, you're going to blow through this account. You're going to run out of money because she's pulling out at about a 5% withdrawal rate. That's just too much. It's like you're pulling too much out of the account every month. But now that I know she actually has $600,000 somewhere, it's locked up in real estate right now, I'm a little less concerned about that. We'll get back to John in just a minute. This is the Jill on Money Show.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And if you've got a financial question, we'd love to hear from you. Just go to jillonmoney.com, click the Contact Us button. Let us know if you would like to join us on the air live. We can do that via audio or video right now. You can also sign up for the free weekly newsletter. Mark puts that out every Friday. It's great. And of course, if you want to spend a few bucks, buy my book, The Great Money Reset. What a great thing to do in the year ahead, a reset. It all lives on our website, so check it out. All right, now let's get back to John and get his game plan set with his mom. So when I think about your situation, I think that that mom is like, okay, I live in a $700,000 place. I've got this great thing. If I didn't have the $600,000 house or other home, I would have, let's just call it about $1 million. She'll have to pay some money to get out. She'll pay some capital gains maybe or not, but she'll have $1 million as invested, right?
Right.
And of that $1 million, she'll need to pull out $2,000 a month, which would be fine. She could pull $3,000 a month out on $1 million. Then she's going to be in great shape. The thing is that because she has this illiquid asset, this second home that's not creating income for her, and it's not growing, and it's not a base from which you can draw, even if it doesn't do very well from one year to the next, but like that actually is an issue for her right now. So I'm not averse to you pulling more money out of this brokerage account right now. My concern is that the house, that second home, we have to get liquid with that at some point. Because I'm thinking like mom's going to live for 10 or, maybe she lived for 10 or 15 more years. If she lives for 10 or 15 more years, you will blow out of that brokerage account. And I'd hate for you to be forced to sell the second property, not just like the wrong time market wise, but the wrong time for her. The time to do it is when somebody is like, yes, I'm aware. Of course, it's overwhelming, but I can be in charge of the process. And I presume that her estate is such that it's equally divided among the 3 siblings, right?
Correct. Yep.
Okay. What I think is your initial question is, could I move the account? Of course, you can move the account. Then you have to manage it, though. Someone's got to manage it, right? Because 1% is not a big number for a $500,000 account. It's actually a pretty good deal because to get actual financial advice or someone who's managing the tax process of selling something off, that actually is a decent price. But if you're not happy with the person and you, John, are willing to take it over and you feel comfortable with it, here's how I would manage that money. I would take that brokerage account and I would say, okay, I'm going to move it into do you do business anywhere? Do you have like a Fidelity account or a Schwab account yourself, John?
Yes, Fidelity.
So I would say, okay, I'm going to move this into a Fidelity brokerage account. And then immediately what I would be doing is making sure that I have 2 years of her expenses in cash. Right now you have 17,000. I would have honestly, I'd probably have like 40 grand in cash, and it would be in a high yielding money market account at Fidelity. And that's what you would use to pay for her expenses out of that cash account. She doesn't have to sell anything right now. She can just like kind of chill out a little bit. And then we know that the money is there for her. Now you can manage the money in a more methodical way. You can say, well, let me look at this account. There is a gain in this stock that we've owned for 30 years, but there's a loss over here. Let's make sure we sell something at a loss, and then we'll sell some of the stock for a gain. And now we'll have a little extra cash, and we can either reinvest it and replenish her, or we can like make her allocation seem a little bit more reasonable. Now, do you feel like that is something you, John, want to take on right now?
Not really, to be honest, but
Okay.
I really appreciate your comments and suggestions because I wanted to make sure we were doing the right thing. The reason I don't want to take it on is if something doesn't work out, I don't want to be, responsible, whether it's
Totally agree. Totally agree. Like you, the last thing you need is you're doing all the work and your siblings like say like, oh, you screwed it up, John. Thanks. And that's not good. So what I would do is I would talk to the broker. Do you have rights on this account? Are you, in other words, has your mom granted you the right to talk to the broker on her behalf?
Yeah, I definitely join her for a couple calls so far over the last 3-4 years. I don't know if formally I, have permission, but he certainly knows me and knows that I'm going to be, asking questions and whatnot on her behalf.
Okay, so what I'd like her to do is to formally make that happen. I want her to give you, have written permission so that she says, you, broker Joe, can talk to my son, John. And I want that to be like something that is possible. And is her estate planning done? Is this account an account that has been managed through the estate process where is it in her name? Has she done all that extra work that you have to do after someone dies?
Yes. Yeah. She just did it. She just wrapped up about 6 months ago.
Okay, great. I mean, not great, but I mean, that's important. So what I think you should do is have a conversation with him and say, are we taking all the losses in the account against the gains in this one stock? That's number one. And what I think I would feel more comfortable doing is to say, I think we need a little bit more cash in the account because we want to have some cash available. Now, you don't have to keep it all there. Does she have a bank account?
She does. Yeah.
How much is in the bank?
I would say 30,000-40,000 total.
Okay. So, maybe what you say to him is like, what we'd like is, we have 30 or 40 in the bank. That's emergency. We'd really like this account to be more like 25 at all times so that she has 1 year of her expenses in cash, right? That's what we really want to happen. And how often is he making the trades to free up money for her?
It appears to me quarterly based on the statements.
I would do it once. I would do it once a year and stop screwing around with that. I would not make that trading happen. I just don't think that's worth it. I think that what I would do is say to him, look, it's the end of the year. So what we want you to do is free up enough money to have $25,000, in cash for mom for 2024. And then let's do it in 6 months, do it again. You don't want to create tax liability if we don't have to, right? And I think that he's got to be a little bit more, and maybe he is doing this, but we want to make sure that there is a real tax neutral pose to this, that we try to take as many, or if there are losses for some reason, if there were, maybe she invested in fixed income at the wrong time because of that, but take the loss, replenish the cash. And then I think you need to have a real conversation with mom, which is, Mom, are you worried? I don't know if she's worried or not, but I think you can say, I'm a little concerned that, just because of the market movements and the amount of money you need, that we have to be prepared in the next 2 years to really think about selling the house. And I really would like to do that when you are 100% aware and ready to make this decision with us, not when we have to do it and you're not able to do that. So can we give her like a 2 or 3 year runway? And I think that makes a lot of sense. When she's ready to sell it, then you and I should talk again when she's ready to sell the second home, because that $1 million, you may not want to send the money to this person. You may want to shop for a new relationship after that. But let's see where you stand. Okay?
Yeah, that sounds good. Thank you, Jill.
All right, John, go take care of your mom. You're a good man. That's a very nice thing that you've been doing. So congratulations for being a good guy, and congratulations to your mother for being such a good mom. If you've got a financial question, we'd love to hear from you. Just go to JillOnMoney.com, click the Contact Us button, and we'll get your note. If you would like a little bit more of us, you can check out a lot of the stuff that we produce on other channels. So, not other radio, but we've got podcasts. And we have a brand new YouTube show. It's called Jill on Money, powered by the Compound. So we have links to that on our website at JillOnMoney.com. Of course, that website has all sorts of great stuff. There's free stuff like the free weekly newsletter and the blog and resources. But if you have some extra money to spend, now's a wonderful time to be thinking about a great money reset. That's my book that was published earlier in 2023. And I feel like it is so perfect for this time of year, not just as a gift, but also as people are contemplating big changes in their lives. The Great Money Reset is available wherever you buy books, or we have links on our website. You can also check out our subscription service called Jill on Money Live. That's where you have access to quarterly live webinars and some cool bonus content. It's the Jill on Money Show. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's the Jill on Money Show. Let's go take a call from Paul, who's on the line from the Midwest. Hello, Paul. What's going on?
It's going well here. We're contemplating a money reset in a few years, and
tell me more. I like the way you think, my man. A reset. What is the reset going to entail? Something exotic?
It's basically transitioning from corporate roles into roles with a little more time freedom. My wife's mother was affected by earlier onset Alzheimer's, and that runs in the family, and that's what really prompted listening to your podcast and reading through the book and starting to put a plan together.
First of all, I'm sorry about that. I love the idea of taking control of it, though, and maybe altering what you thought was going to be your destiny. And I think this is a great idea. So let's start with some of the basics, Paul. How old are you?
I'm a little over 50, 53.
That's a little bit of a fudge you just did there.
My wife's 50.
Yeah, a little over, when you said a little over 50, I'm like, 50 and a half? No, 53. That's a real, okay. And your wife is 50.
Correct.
How much do you earn right now in your corporate jobs?
We make on the order of $28,000 a month, excluding taxes.
Is that a net number that you're giving me, or is that
net
a gross
of
number?
Taxes, correct.
Okay. You have kids?
We do, 3.
Oh, how old are they?
15, 17, and 19.
Have you guys set aside money for college for the kids?
We have. We've started 529s the month each was born, and we have enough to fund state schools. And with merit aid and any loans, they know they can cover the rest.
That's great. Is the sophomore in college in a state college?
He is in a private college, but he got merit aid that was basically equivalent to state school. So he's in good shape.
Okay, great. What about your home? Do you have you still have kids at home. So what's your house worth?
Our house is worth $650,000 if you believe Zillow.
Okay, why not? What about a mortgage? Do you have one?
We don't on our home.
Is that it for the property, the primary, or is there anything else?
We have a cabin that's worth $550,000, and that.
What's with you Midwestern? Can I just say one thing? You Midwesterners, you kind of rock my world. You say the word cabin, and I think it's like, it's a one-room log cabin, but it's not. It's a fancy house, isn't it?
This one is pretty small. It's about 1,000 square feet, and
how could it be $550,000?
We bought it for a lot less than that in 2018.
Really?
Yeah.
Do you have a mortgage on that one?
We have a small mortgage of $70,000.
What's the interest rate on that?
3.25.
Would either of these homes be available for sale to help finance your transition from the corporate roles?
Out of the gate, no. At some point, we would downsize. We don't need a home the size that we're currently in. Once the kids are launched, we'll.
Fair enough. Okay, now let's talk about the money that you have saved in investment assets. So you got a big chunk of money of income. What have you put aside in retirement plans?
We have a $2.3 million in 401ks.
Are those pre-tax?
Yep.
What else?
And then $200K in Roth 401ks. We just started those a few years back.
Okay.
And we have $100,000 in a traditional IRA and $45,000 in a Roth.
Cash in the bank?
We have $400K in a money market account, normal checking account, not a large balance there. Mm-hmm. And then $180K in a brokerage and $25K in a HSA.
So this is a lot of money. Will either of you be entitled to a pension?
I will get a small $1,000 a month pension from a prior employer that can start in 2027.
Is there a game plan right now? Because, I mean, look, you're young, right? So is there an idea of timing for this?
Yeah, we're thinking between 2026 and 2028.
Would you guys be working, just making much less money? Is that the
we would.
Plan?
We're thinking about renting out the cabin a few months each year to make a little bit of income, and then a wholesale club, home improvement store, that kind of work on the side, but more part-time with a lot more time freedom. So
between renting the cabin and the part-time income, I'm just going to use 2027 since you said 26 to 28. I'm going to say, also because it just so happens that that's when your pension kicks in. So just for argument, let's just look at 2027. What would you, in today's dollars is okay. What do you think the rent would bring in from the cabin?
I think the cabin probably $15,000 a year.
Part-time income, what do you think that you would be counting on?
$85,000 a year between the two of us.
I'm going to say 80. Do you think that you could live on your pension income, your rental of the cabin, and the part-time income? Could you live on that amount of money, or are we going to need to dip into some of your assets for that?
I think we will dip into some of our assets. Our expenses today are about $15,000 a month.
Presuming that you bring in 9 between the pension, the rental, and your regular income, then we just have to find $6,000 a month, right? This is all simple math, everybody. This is what we call the old back of the envelope kind of calculation. I'm not carrying interest. I'm not carrying for inflation. I get it, because sometimes I get some complaints about that. But it's simple math, and we can just kind of give it a go here. So how long would you be willing to put the transition period into effect? So if you started in 2027, right, 4 years from now, you're 57, your wife's 54. How long are we willing to do that for?
A couple years, and we're trying to build our brokerage position and money market position over the coming years to have enough to cover at least those 2 years before I could tap my 401k.
We'll get back to Paul in just a minute. If you'd like to talk about your reset, go to JillOnMoney.com and click the Contact Us button. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. Let's get back to Paul, who is contemplating a reset. What about healthcare? I mean, you got a lot of years before 65.
Yeah.
Would you just use the Affordable Care Act?
The job, I budgeted $15,000 a year. I don't know if that's near enough, but the jobs
That's
that
probably
we're
right.
looking at, part-time jobs, do have some benefits with them,
Oh,
but
okay.
we're a ways away from that.
I presume because you have very high income, both of you, that your age 67 and 70 Social Security benefits are pretty rich. Do you have an idea of the estimate?
I do. At full retirement age, mine will be $38,000 and my wife's $30,000. At 70, mine's $45,000, and I don't think I'll take mine until then.
If I'm hearing you right, you're in your early 50s. You want to essentially take the money that you're making now and try to really front load your money market and brokerage account, right? Are you pulling back on retirement contributions right now or not?
Yeah, we just took them down to the company match
Okay, that's good.
a month or two ago.
All right. So now all the excess is going in brokerage and money market. You work for a few more years, 2-3 more years. I mean, look, if the markets are good to you, maybe you'll look at this in 2 years and say, you know what? We're in good shape. We're going to reallocate. We're going to lock in some of these gains. We're good. I think you'll have plenty of money. I mean, when I think about what you're hoping to accomplish, I think because you're willing to both work part-time for a couple of years, it's a big advantage. Your fail-safe option is, yes, I think this can work. You may have to work more than 2 years. It might be that it's more like 3 years or 4 years if something bad goes on, right? If there's like a horrible recession and markets are in like free fall and you can't really make 80 grand a year. For a couple of years, you made 60 and you had to dip more into your money. But if you're flexible, then I think you can do this, because obviously by the time you're ready to access some retirement accounts, you'll start pulling money out. You'll pay the tax that's due. You will be able to make it to your age 70 pretty easily. You will definitely plow through some cash, but it doesn't seem like you're huge spenders. And it also seems like the other side of the fail-safe package is not just that you would work, but that you could eventually sell one of these homes. Maybe both, we'll see. But let's say it's one, or even just not even sell it outright and just pocket the money, but maybe it's sell it and spend some money on a smaller place. And we'll see where your kids end up. That's going to obviously play into this. In case interest rates start coming down next year, and I don't know if they are or not, but let's just say they do, maybe today it might make sense to get some of that money market account. I know you like the liquidity, but maybe I would buy like a 5-year, a 3-year, a 2-year CD and lock that in.
Here's the kicker with that. We are starting a cabin edition.
Oh, hello. You didn't. What was that? Where was that in my whole story?
Sorry, I didn't get to that sooner.
Uh-huh.
And that will be about $300,000. So
What?
It takes that 400 down to 1.
Oh, you're killing me, dude. That's not, you're building a whole nother cabin. Do you have to do that? Oh my God. All right, let me ask you this. Are you willing to keep working full-time in your crapo corporate jobs that you hate while that's going on?
I can work longer. I enjoy my job. I think my wife is a little bit more burned out.
Well, let's take her off the hook. Okay, you're going to plow through all that cash. That's one thing. But then you have got to make the pinky swear that you're going to stay in your horrible corporate job for a little bit longer till we can get that cash position built back up. I didn't realize we were going to spend all your cash down. Dang it.
Yeah, I think I can get to $300,000 in the money market and probably $300,000 in a brokerage by the 2026 timeframe.
Let's see.
I can see where working another year or two
Going to help. Every year, every month you extend it, the better it's going to be. I'm sort of thinking that, okay, let's say that in 3 years, your wife's 53, you're 56. See where things stand, right? And then it might be you say to her, babe, you know what? You're done. I'm going to keep working. And maybe you're going to work for another couple of years. Maybe you're going to work till you're 59 and a half because you just want to like bridge that gap. And that allows you to really replenish this money. If you're willing to do that, I'm on board with a game plan.
Okay.
But if you're like going to do a little bait and switch on Aunt Jill and say, yeah, I'll do that. And then it's like, no, I don't want to, she's going to retire without me. She's going to have fun without. No, I mean, it's just like sort of a grown up decision. And I think it's great. But the premise of a reset is that you are willing to make some sacrifice, and your sacrifice may be, for some people, it's like, I just won't spend as much money. You read the book, For others, it's I will work longer, or one of us will work longer because it allows the other to take a chill. Or you might say that if you're able to work a little bit longer in your full-time gig and then also work a little bit longer for your part-time gig, it all works. But we have to be flexible in approaching this kind of big, huge decision.
No, I like that. And I like potentially transitioning one of us out of a corporate role into more of a part-time role first and get some experience with that before we both.
You first, honey. Now, have you done your estate planning, Paul?
We have. It was last updated in 2018.
Thank goodness. If you would like to reset your life, just give us a holler. Go to JillOnMoney.com and click the Contact Us button. We'd be delighted to help you out. We'll be right back. You're back. It's Jill on Money. Before we finish up the show, let's do an email. Yes, I know we do emails from time to time. This is from Adam, who writes, I'm 40 years old and have been contributing to my employer 401k and a Roth IRA. I'm confused as to what I should be putting my 15% in. What percentage should go in a target date fund versus an S&P 500 fund versus a mid-cap fund? Oh, Adam, I'm so glad you wrote this note, because in my mind, this is one of the big decisions around asset allocation is inside of your retirement account, right? And if you're using a target date fund, which can be a really easy way to get your investment feet wet, it is a great thing. But two things to remember. One, target date funds, which target a date of retirement in the future, may be more expensive than you realize. So you want to check out the expense ratio in that target date fund. And if you're starting with small dollars, you would put all of your money in that target date fund. They'll pick what percentage to put in large cap or mid cap or international. However, if you feel like you want to really better manage the funds and be a little bit more cost effective, it's usually cheaper to use a bunch of index funds. And when I say a bunch, I really mean just maybe 3 or 4. That can be an extended market index or an index fund like the S&P 500. Maybe there would be some mid cap or small cap, up to you. Maybe there would be some international stock. Maybe there would be a bond fund, and maybe even a commodities fund. Each of your retirement account plans usually has a risk assessment questionnaire, and it can help you develop an allocation plan. But again, if you're just starting out and you feel like it's overwhelming, it can really be helpful just to use that target date fund or follow up with us, and we'll walk you through what your options are and what might work best for you. And then we could kind of set it and forget it. So give us a holler, Adam. We'd be delighted to help you out. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and web king. Lift someone up, change your work, change your wealth, change your life. Thanks for listening. Happy New Year. Be safe. We'll talk to you next week.